So I think most of us have joined. Welcome to this inaugural webinar in a series for FE and HE attendees. This is a breakdown of two aspects of the new 2026 SORP. And today we're going to be smashing revenue until it's simple. So we've got an hour together. Joe and I are going to probably talk for about 45 minutes. At the end, there will be 15 minutes for Q&A. The chat function, I believe, is open. So as we go along, feel free to pop your question in. We're joined with a number of the team today. In a separate room is Joanne and Sadir, and they'll be monitoring the chat function and helping us out with the Q&A at the end. But as I said, I'm joined here today with Joe, and he's going to be doing quite a lot of the talking, which is good for me, bad for him. No. So, of course not. So what are we going to cover today? As I said, this is a focus on revenue accounting or income accounting. We will go through a bit more of a sort of theoretical, high-level overview, understanding the new requirements that are contained within this SORP. We'll be looking at how that compares with current practice. We'll talk to you a little bit about how you can start implementing that and what the first day and actually that transition period will look like. And we'll go through some worked examples and real life scenarios, and then we'll finish with the Q&A. So just so everyone is aware of what we're talking about, this is the 2026 SORP. It was published at the back end of the year, 3rd of November. So we haven't had a massive amount of time to get to grips with it. It is for accounting periods starting on or after the 1st of January 2026. So hey, we're 20 days into that new exciting era. For most of you out there, this is going to affect your 26, 27 year ends. So for the FE institutions out there, it'll be July 27 year ends. But why are we talking to you about this now? It's because the first day of accounting period for you will be on the 1st of August 26. So it's important to know what's coming your way. We do appreciate that we're talking to various people on this webinar from Further and Higher Education. Appreciate some bits will have greater sets of relevance to both sides, but the theory is applicable to everybody. Where we're going to try and sort of build in each side to make sure that your ears prick up at that point. There are elements of judgment in here, so just be aware. This is our initial interpretation. It is subject to change because at the end of the day, we don't have sort of real life implementation on this one. And that's what GAP is all about, generally accepted accounting principles. And we don't also have the college accounts direction or the OFS accounts direction either, which are likely to be drafted later on in the year, which will give a bit more of a sturdy background and understanding of some of the elements in here. It's important to note that everything that we're saying today will appear on our website. It comes under our trustee hub, which there's a link at the bottom of your screen there. Give us a week or two, and this webinar will appear in there as a recording, so you can go back and look at it to your heart's content, or indeed share with your best friend. Bearing in mind, today is the first one of two webinars. 2 weeks today, 3rd of February, we're going to be talking about leases. So hopefully that is of interest. So I'm going to hand over to Joe, who's going to start talking to us about theory.
Talking to you indeed, yes. So I'm going to be covering the new requirements about revenue accounting in the new SORP and trying to compare them with the previous SORP, the 2020-2019 SORP. And we're going to focus on the three income sections, 16, 17 and 18. And hey, on the surface of it, hardly anything's changed, right? They've only changed the title of section 16. But don't be deceived. That is certainly not to suggest that there's very little change in each of those sections. We're going to go through each of them in turn and hopefully pick out some of the major topics of conversation. So let's start with 16, revenue from contracts with customers. This is the meaty one. This is the big change. This is where we see most of the changes in FRS 102 reflected in our SORP. But fundamentally, what this section applies to, the transactions that this section applies to, hasn't changed that much. There's still transactions with customers, and we're still looking at revenue from transactions that have commercial substance. I've underlined commercial substance because that's a really key phrase, I think, that's going to feature throughout this section, and probably something we're going to come back to a little later on. But annoyingly, it's not defined anywhere. It's not defined in the SORP. FRS 102 don't include it in their glossary. So you've kind of got to have a little bit of a think about it yourself, draw from inspiration elsewhere, and at least kind of read between the lines a little bit, perhaps, in the SORP. The examples that the SORP provide in section 16 are unchanged. We're still talking about tuition fees paid by students, whether or not that's the cash coming from them specifically or a kind of funding company like student loan company. We're still talking about revenue from consultancy and other commercial revenue as well. So all of that catering, the publications, the accommodation, all of those extra bits and bobs where there is commercial substance. That's what this section relates to. And the seismic change here is that the old revenue recognition model, where we're thinking about, explicitly, reliably measurable amounts, the probability of receipts and an economic benefit, we're thinking about stages of completion, that's gone. That's been replaced by the kind of much lauded FRS 102 5-step model, emphasis on much lauded. And whilst, that doesn't fundamentally change some of those kind of key concepts within the old model, it kind of puts it into a different perspective and a new order that might well have some impact on the transactions that you're dealing with at your institution. So we're going to go through each of those 5 steps now. As Stu said, it's going to be a relatively high-level theoretical explanation of each of them, with a couple of kind of sector-specific tidbits in there for us to go into. So where better to start than step 1? And this is all about identifying a contract with your customer. It kind of makes sense that you can't, recognize revenue without a contract. And the SORP goes into a lot of detail to explain that there are 5 criteria that it believes represent a contract, and it's only when all 5 of those criteria are met that we can do so and start going down this revenue recognition route. But those 5 criteria aren't completely abnormal. They're not out of nowhere. The SORP just hasn't made them up. They're kind of rooted in UK contract law. And so when the SORP talks about the need for approval and commitment from both sides, they're really talking about offer and acceptance, making sure that both sides of the contract want to be there and they agree to what they're doing. When the SORP talks about identifiable rights, and when it talks about payment for goods and services, it's referring to that contract law certainty and completeness of terms. Does everyone actually know what they're getting into? And hey, here we go. There's another reference to that commercial substance in the 4th criteria. I've linked that, or kind of think of that most likely in UK contract law in terms of the intention to create legal relations, or for there to be that legal consequence for delivering or not delivering one side of the contract. And finally, the 5th element that the SORP details is all about whether it's probable that the customer is going to pay, or that they intend to pay. And hey, probable, that's a phrase that we've heard before. We're hopefully relatively comfortable with that. In terms of UK contract law, consideration, there's amounts that will be paid, there's numbers, there's cash or equivalent moving hands. So we've got in our first step of 5 sub-criteria that we need to consider for each contract. What does that look like? What does that look like for you and your institution? What does that look like for tuition fees? Is it a signed acceptance letter? Is it a student contract? Is it an enrollment form? Is it a funding agreement? For consultancy or other types of commercial income, are there signed SLAs in place? Are there going to be agreements with third-party providers? So that's the kind of level of detail that we're going to need to be going into, I think, when assessing each of these. Step two is all about identifying performance obligations within that contract. You know the contract exists. Let's go into it. What does it actually include? And the SORP says that you must go and identify goods and services that are promised in that contract and identify whether or not there are performance obligations to transfer what it defines as distinct or a series of distinct goods and services. And distinct's the kind of key word there. We need to make sure that these goods or services being promised in that contract can be benefited from on their own right. Customers can actually benefit from that good or service. But it also means that the entity's promise to transfer that good is separate from other promises, right? The contract may be made up of several different promises, but we need to identify the distinct ones within there. And we also need to think about principal agent situations. It's not uncommon for FE and HE institutions maybe to get collaborative with other colleges, with other research institutions, perhaps, to kind of come up with a contract together. What's really important, I think, that you do at this step is identify what the performance obligation is for your own entity. Is it that you were providing the goods and services, or actually you're going to arrange for someone else to provide those goods and services? Because depending on which one it is, will impact massively when the performance obligation has been met. Okay. Step three is a really juicy one. Step three is all about the transaction price. So this is the amount of consideration which the institution expects to be entitled to in exchange. It's that consideration that's detailed within that contract. But there are four kind of sub-factors that we need to consider specifically within each of our contracts. And the first is variable consideration. And what does the SORP mean by variable consideration? It's talking about discounts, it's talking about refunds, it's talking about contingent income that might be dependent on something happening in the future, right? And in acknowledgement of the fact that it is variable, the SORP is saying, well, you won't know necessarily right off from the beginning what that's going to be, how much it's going to be, so you need to estimate it, right? That's fine. We're used to making estimates. It's part and parcel of preparing statutory accounts, right, and accountancy. But it's, again, really reassuring us or kind of insisting that we use highly probable information. We make sure that we are not making estimates that we can't substantiate. And like any good estimate, it's requiring us to reassess these at each reporting period, making sure that we're keeping on top of those to ensure that if there have been changes in the variability of that consideration, that that's been picked up and reflected. An important point to note, I think, is that when we have a contract with multiple different performance obligations, it might be that variable consideration relates to only one of those performance obligations. And so if we're reassessing that estimate and it changes, we don't apply the difference in the estimate to all of the performance obligations. It's got to be to that specific one that you've identified. So it's already suggesting, I think, that we need to go into granular detail with these contracts and really understand what's being promised. The second of those subcategories or sub-considerations is the time value of money. And hey, we're all kind of finance bods here. Perhaps we hark back to college. We remember time value of money if maybe we don't utilize it every day. We need to kind of break down our understanding of the consideration that's going to be transferred as part of our contracts. If we're going to receive it within 12 months of that contract, happy days. We don't need to worry about the time value of money. If we're going to receive it in advance, then the institution can choose to take into account the time value of money. But hey, if payments received beyond normal business terms and it's financed by the institution, if credit's provided, for example, then we absolutely must account for the time value of money. And so there's a bit of judgment in there. There's an option to do it if you wish, but there are certainly times where you must do it. And in all of those cases, we need to come up with a present value. How do we do that? We need a discount rate. That's another area of estimate and judgment that we'll need to make sure we're substantiating and documenting. And we unwind the interest income or expense over the length of contract. Right? So there might be some kind of mathematical recalculations involved as part of that exercise. You'll be pleased to know that the third sub-consideration about non-cash consideration, the SORP is very, very quiet on. It just says you've got to measure it at fair value. Simple enough, perhaps, but of course, fair value is not always an easy concept. I think the most significant sub-consideration, especially for higher education institutions, is about consideration payable to a customer, which is a phrase I think is a little bit clunky. It's not the neatest, it's not the most obvious perhaps when you think about it right away, but the SORP's very kind in defining what it believes consideration payable to a customer is. They're talking about bursaries, they're talking about scholarships, they're talking about student support, either at the commencement of a relationship or in the future. And in all instances, that consideration payable to a customer, if it's for a distinct good or service, it should be treated as a reduction in the transaction price. So we're trying to determine the transaction price. How do we do that? We need to consider everything. It's not just the cost of the promise, it's other factors. It might be those bursaries as well. And hey, if that bursary or scholarship is linked explicitly to the initial admission process or continued attendance of a student, then you treat it there and then with that transaction price. But there might be student support payments, one of the examples the SORP gives, that requires a bit more judgment. The example they gives a hardship payment. Right, you might be sitting on a restricted fund that's exists just for the issuance of hardship payments, but you need to consider whether or not that does represent a reduction in the transaction price, bearing in mind the transaction in this instance is admission onto the course. Right, if that hardship payment doesn't prevent the student from continuing their course or starting their course, then it arguably isn't a reduction to the transaction price. It's just a separate expense. So a bit of consideration needed there as well. But you recognize that reduction in revenue at the later of the time that you recognize the revenue, or when you make the promise to actually pay it. So you might offer the scholarship in advance of actually entering the contract. So the later of those two. The SORP kind of includes what I thought was a rather confusing paragraph, but after kind of hashing it out with the team, I think I got my head around it in the end. For those very, very unusual circumstances where perhaps the consideration payable to a customer exceeds the amount receivable from the customer. So, for example, when a bursary exceeds the value of admission, it might be 110% bursary to ensure that student comes to our institution. The SORP clarifies that the FRS 102 gives us no guidance on that at all. So we need to be judgmental. We just need to make our own judgment, apply it consistently. Does that represent excess payments and so expenditure, or is it negative revenue? Be clear, be sound about it. Just noting briefly about disclosure considerations now. I appreciate it's not part of the 5-step process, but as part of the SORP consultation, we really wanted the SORP to be explicit and demand a disclosure of this exercise of taking that gross transaction price and reducing it by consideration payable to customers, but there isn't that requirement. So you might want to consider that yourself, whether or not you want to disclose that separately to show that public benefit, which is essentially the issuance of those bursaries and scholarships. On to step 4, we've identified our contract, we've identified our performance obligations, we know our transaction price. We now need to allocate that transaction price between each of our performance obligations. And there might be unlimited performance obligations, but we need to allocate it accordingly. The SORP says that we need to do it on a standalone selling price basis, which thankfully it goes on to describe in a bit more detail to say, hey, if I was going to sell this performance obligation separately, how would I do that? How much would I charge? But in acknowledgement of the fact that a contract might have several performance obligations that can't be separated out, I might not sell performance obligation 1 exclusive of number 2. The SORP does give you the option to estimate that split. And again, you need to consider all of your available information. You need to think about market conditions, etc. But it's another area of estimate and judgment. Document that. Make sure everyone's on board with it. Okay, and with any estimate, reassess at the year end and make any changes to the specific performance obligation that it relates to if needs be. Finally, we're almost there, crikey, step 5, we actually get around to the recognition part. So we need to think about when can we recognise the revenue or the portion of that transaction price that relates to each of our performance obligations. And we need to think at the inception of our contract and the identification of these performance obligations, whether or not they're being satisfied over time or at a specific point in time. And without that distinction, you can't really get to the revenue recognition part, right? But if you conclude that they're being satisfied over time, great stuff. Then we measure and recognize our income over time as well, in line with our progress towards the complete satisfaction of that obligation. If, on the other hand, we're recognizing it at a point in time, right, we recognize our income at that point in time. Okay. So there are 5 steps. That's revenue with contracts with customers. Section 17 and government grants. You'll be very pleased to hear that, as I've put in big caps at the bottom of this slide, there's very, very little change. Our definition is unchanged. We're still talking about funding that's provided by government bodies, to not include donations or funding from charities, etc., non-exchange transactions. They've got the same examples that they set out there as well. They've removed EU funding for obvious reasons, and they're still acknowledging the fact that government grants can be a little bit judgmental. Some of them can have similarities with non-exchange transactions, but hey, they are government grants. We need to treat them separately. But separately is the same as the previous SORP. So we've still got our accruals model, we've still got our performance model. Our accruals model is obviously broken down into our revenue government grants that need to be recognised on a systematic basis in relation to the costs that the grant are intended to compensate. And we have capital government grants as well. And again, we recognise them on a systematic basis over the useful economic life of the asset which the grant has been used to purchase. Just a reminder that capital government grants relating to land specifically, you cannot use the accruals model, you must use the performance model. And hey, we're talking about performance related conditions again. And so hopefully that's relatively familiar. You've been doing it already, but it also kind of harks back and overlaps a little bit already with that 5-step process. Sticking with government grants and noting how things haven't really changed, that they do include funds that are received to support education, for research as well. You certainly get research grants from government agencies. We're acknowledging the fact that government grants can be, or programs can be part funded by government and non-government. And in those instances, you need to consider each element of funding separately and account for it accordingly. That accruals or performance model is a choice, but it must be applied consistently per class of grants. So if you've got lots of different government grants, but actually they're kind of very similar in nature or substance, then make sure you're applying that model consistently. I've already noted that capital government grants for land have to be accounted on that performance model. And the SORP acknowledges again that grants could be for both capital and non-capital. And so a bit like when your program is funded by government and non-government, you need to think about each component of the funding and split them and account for them accordingly. And don't forget that government grants can often give rise to restrictions if it's for a particular project, if it's for a particular discipline. Thankfully, the SORP has kept one of its several little helpful flowcharts. I appreciate you might not be able to read it there, but go find it in the SORP. It's a really, really simple and useful tool to kind of get you started in terms of how to account for each of these. Non-exchange transactions is our third and final revenue section in the SORP. The definition, again, unchanged. We're talking about entities receiving value from others without directly approximately equal value in exchange. Yeah. And so, hey, the definition hasn't changed. Does that mean that nothing else has changed? Well, no, not really. I mean, the introduction of this section looks quite different from the previous SORP. It really splits out and expands the introduction to several headings. We've got recognition, measurement, and presentation. And recognition reiterates the fact that we only recognize these transactions when they're measured reliably. So again, that old revenue recognition model that we were talking about earlier, some of the familiar phrases in there. But thankfully, the SORP finally starts talking about donated services and facilities and resources, which it had previously been completely silent on, which I've certainly come across several instances with clients when that was really unhelpful. So the SORP introduces volunteer time. It explains that it's not actually expecting you to be able to reliably measure that. It's quite difficult. How do you value someone's time over someone else's? It talks about the fact that when you receive, for example, high volumes of low-value second-hand items for distribution, you need not estimate the value upon receipt. You can do it upon distribution. I can't think of many further or higher education institutions that kind of run charity shops or the like, or other programs that. But hey, I'd love to hear if there are any. It talks about donated resources. And when they are issued or given to an institution for the use in the production of an asset, you need to consider that as income as well as part of the cost of that asset. And it goes into a little bit of detail, but not too much detail, more of just a signpost to FRS 102 about leases, when an institution might enter a lease for a non-exchange that contains a bit of a non-exchange transaction. So when it's at a discount, whether it's below market rents, or whether actually it's at peppercorn rent at all, there is an element of a donation going on there, an element of a non-exchange transaction that must be recognised. We're going to go into that in a lot more detail in the leases webinar that Stu mentioned in a fortnight's time, just because I think it kind of flows a bit neater from there. It also introduces legacy income for the first time, but again, it's not too detailed. It just says, think about it, go have a look at FRS 102. So at least we've got a bit of kind of clearer guidance or directional guidance to hang our hat on when recognising that income. And then in the measurement section, it again goes into a bit more detail about how to recognise and measure those donated services and facilities. And it's at the value to the institution. And that's a really important definition, I think, that had been missing in the previous SORP. It thankfully gives its own interpretation of that definition. It's the price that the institution estimates it would have paid on the open market for the service or facility. And then all other non-exchange transactions measured at their fair value. We talked about fair value earlier being perhaps quite a simple concept, but actually quite complex at times. And again, the SORP's given its definition there in this instance of saying that it's that price when the institution would have paid. So no estimate involved here. What would you have actually paid? No change in terms of presentation of requirements for non-exchange transactions, but it does clarify, I think much needed, that judgment again is needed in identifying the correct accounting treatment for all revenue transactions, not just non-exchange transactions. So lots of similarities, lots of things unchanged, like with government grants, with the definitions of donations and endowments haven't changed. When we're thinking about accounting for donations and endowments, again, I think some paragraphs might have been split in two or something. There might be an extra bullet point, but the content's exactly the same. It's performance-related. If donations have performance-related conditions, it's over to that performance model, and donations with no restrictions, it's not about when entitlement arises, it's about when it's received or receivable. And hey, just to prove that we're not in isolation as not-for-profit specialists, and you working with FE and HE institutions don't need to silo yourself in that category. If you're applying total returns for accounting for endowments, go to the charity SORP. The FEHE SORP sends us directly to the charity SORP for those considerations. Another flowchart that's unchanged. I find them really useful. A really nice starter for 10. So, whistle stop tour. Stu, back to you for some specifics.
So I just thought I'd sort of pause before we go into the examples at this point, because those of you from FE institutions might be sitting there going, okay, well, where does my core income stream sit? The 16 to 19 funding apprenticeships, adult skill fund, and those types of grants. And you might be sort of sitting there going, well, okay, I've got my three sections 16, 17 and 18, and which one does it fit into? And you might well be forgiven for thinking, oh, well, maybe it's not that 5-step model. Maybe it's a government grant. And you would be forgiven, I suppose, if you had a look at section 16.4 of that SORP, and it talks about funding from government sources, essentially that aren't deemed to be commercial substance. Essentially, that is when you go to section 17 and potentially section 18, and you account for them as government grants. And so you might be sitting there thinking, well, does my core income stream fit into that box? And at this stage, it's a little bit up for interpretation. And so what we've done is we've sort of said, okay, well, let's look at section 16, 17, and 18. And in reverse order, actually, in 18, they're not going to be in there. Okay, so it will be an exchange transaction, because at the end of the day, each of those income streams, you're getting funding for a specific purpose in there, and it is student based. So it would be described as an exchange transaction. So automatically we are in 16 or 17 in there. And the bit where we go let's go to section 16 is does it need to follow this 5-step model? And there's the answer to this is it will depend, and potentially it's an area of judgment. But where we've gone with this is we've looked at it and said, well, actually, let's look at the commercial substance here. And in each of the instances, we've got funding that is determined by student numbers. It determines by what study programs they're on, their retention, and it's subject to conditions being met over the deliverability of those courses and education provisions. And indeed, the amounts are recoverable or adjusted for if delivery doesn't occur. So where we're sitting right now is, in the absence of anything more concrete, we're probably going down the route that, yeah, actually your core income streams would be deemed to be a contract with customer rather than a government grant. That's obviously subject to change. So you might sit there and think, oh, I thought I didn't have to do this 5-step model and it would only apply to my commercial income, but that might not be the case. But all is not lost, because actually, if you go down and say, well, hang on, is there going to be a difference? And specifically for FE institutions, I'll talk to now, because your funding year is arguably pretty much coterminous with the academic year, you've got to ask yourself, well, actually, is my current basis, my accruals or performance related model, going to be any different to what that 5-step model is going to churn out? And because you will get to the end of an academic year, all things are done and dusted, you will have probably met the 5-step process in order to recognise your revenue. And then there's just that post-year end adjustment for things that go through your ILR, where your data is improved for levers, etc., and underperformance and the like. So the 5-step model and the performance model for government grants, they're not too dissimilar. So actually, you will probably get to the same end result. But nonetheless, it is important to recognise that if it is section 16, you do still have to go through that thought process, and just to make sure that there isn't any fundamental difference. And there might be something on transition as well. So do pay attention to that bit.
And I guess that's when the accounts directions will be hopefully
useful.
Yeah.
I think the accounts directions are going to have to talk through that in a fair amount of detail. So we will get clarity on that. So let us just turn to that bit about transition. And let's get the good news over and done with. The good news here is there are transition arrangements in place that is afforded to us by FRS 102. It's quite well hidden. To be fair, section 1.62, if you really want to go there, where it talks about how you will implement these changes. And the good news is you do not restate your comparatives. Okay, so what you do is you look at it as if you're applying it on day one of your first accounting period, but you do need to take into account any contracts that are spanning that year end, because essentially any contracts that aren't completed on that day of application, you might have to retrospectively adjust for. How do you go about doing that? We've got in there a little slide. It goes through your statement of changes in reserves as an opening balance adjustment. So your comparatives stay the same. You then represent your opening balance adjustment if there is one, and then you carry on as if this accounting policy has been in existence since forever. This, for want of a better word, is called a modified retrospective approach. You might be saying, why on earth are you talking to me about that? Well, it's important that because it's the same approach used for leases as well. But with leases, there is an option going through there. So it's important to know. So before we go on to the worked examples, just a couple of practical tips for everybody to think about. You can start right now, realistically, going through a detailed review of your income streams. I'd strongly suggest you do that, putting them into boxes for section 16, 17, and 18 for the ones that you're really clear about. There will be a pot of don't knows or unknowns. That's absolutely fine. You can perhaps leave those to a bit of a later date when we get more clarity, but certainly do a detailed review of the income streams and start identifying where appropriate those performance conditions. Really pay attention to agreements or income streams that will span accounting periods. Those are the ones that you need to get on top of very quickly. We do still have time, as we mentioned here, for most institutions, this is 26, 27 year ends, but it's that first day of the accounting period that's going to hit you first. So it's those ones that span multiple accounting periods that you need to watch out for. Do look at each income stream and start documenting the performance obligations, the values in the contracts, and start determining those pieces under the 5-step model. Do be aware that, you know, things can get complicated quite quickly. Mixed goods and service bundles and bundled items and variables amounts of pays, discounts, penalties, refunds, they all make things a bit more complicated. And essentially what will come down to, as Joe talked about, estimates and judgments, and essentially policies will be needed to be enacted for some of these. So you might want to start thinking about that. Then think about your financial reporting processes, indeed how your organization tracks performance measures, because sometimes these could be non-financial metrics and it's not often built into accounting and finance systems. So for the ones that do have performance metrics that are non-financial, you will need to think as a finance team about how you're going to track those and how you're going to enable that communication line to go through that allows you to recognize income when performance criteria are met, or indeed when it's not met, and there's doubt over those that would stop you from recognizing income. Make sure your finance team are well trained to pick up on transactions, new transactions and new revenue streams that come through. They need to be able to identify those in good time. Talk to your professional advisor. Why would you do that? Of course you should. You know, that's what they're there for. Talk to your auditors and advisors early on. Think about having conversations that are specific to you. Hopefully you'll walk away today with some good understanding of what to look for, but make sure you engage early in the process. And then you can start potentially modeling them. And some of these will have knock-on effects for financial health scoring, which we will see coming through in the accounts directions and so forth. So let's go through some worked examples, Joe.
Yeah, let's do it. We'll try and rattle through these as quickly as possible so that we've got some time for questions. But I guess it's probably just worth reiterating that these are very simple examples. You know, that we've tried to tailor them based on the types of transactions that may well arise in your institution. But we appreciate that you will have far more complex and specific scenarios that you will want to work through. But hopefully these kind of get you thinking about some of those new or specific things that have been mentioned in the SORP, and kind of going through that process and where it needs to be. So I thought we'd start with tuition fees, with bursaries. And in this example, we have a student who's been offered a place on the geography and economics course. That sounds like a good degree to me, well worth doing. And the student gets sent their student contract, gleefully accepted, signed and returned. Happy days. The contract itself with the student, it relates just to the provision of the degree course. And it clarifies that the annual fee is the current undergraduate cap of 9,535. However, this student successfully applied for the sales scholarship. A good scholarship, what a generous person that must be, eh? £2,000 for that first year of study. Okay, so this is revenue from contracts with customers. It's tuition fees. And so we need to identify whether or not a contract with a customer exists, and whether those 5 sub-criteria have been met. The scenario is very brief and a little vague at times, but it suggests so. There is a student contract in place. Let's assume that that covers all of those 5 criteria. Our step 2 is to identify the performance obligation within the contract. And the scenario again details that there is just one of those. There is just one performance obligation. It's for the provision of the degree course. Simple as that. Our third step is that determining of the transaction price. And as we talked a little bit about earlier, as the SORP sets out, scholarships need to be treated as a reduction in the total consideration. So our fee is reduced by that scholarship amount. Our transaction price is £7,535. That total transaction price needs to be allocated between the performance obligations, which we've established there is only one in this situation. So it gets entirely allocated to that. And so our final step is about when to recognise that revenue. And we can, I think, deduce from this scenario that the performance obligation is met over time, being the length of the course or the length of that first year. And so again, the associated transaction price should be recognised over the length of the course itself. If that course isn't coterminous with the reporting date, if my reporting date is the 31st of December, but I start my course in the September of the year before, then there will be a contract balance that's outstanding at the year end, and that will need to be recognised on our balance sheet. Okay, so quite a simple example there. Another revenue from contract with customer example, this time a little bit more complicated. We've got a college that's outsourcing the operation of its canteen to a third party, Yum Yum Limited. I may or may not have been eating baked goods at the time of drafting this. And they have a service level agreement in place, and it's been there for the last few years. And that SLA stipulates that the college will receive 10% of the average gross income collected by Yum Yum Limited over the previous rolling 3-year period. So we've got the data there from the last 4 years or so that we could be helpful. But unbeknown to the college, learner profiles have changed over the course of our current year, and the canteen has been more popular than ever. And in our current year, July 27, it took £1.65 million. Oh, £200,000 more. That's a lot of Yum Yums, isn't it? Absolutely. So step 1, identify the contract with the customer. The scenario again suggests that the 5 criteria have been met. There's an SLA in place. Hopefully that covers all those bases. Again, identify performance obligations within the contract. There's just one in this example, the provision of those catering services. And this is, I think, when it gets a little bit interesting, because we need to determine that transaction price, and hopefully it's obvious that the consideration is variable. It's based on that rolling average over a 3-year period. And so the college needs to estimate what that transaction price needs to be or is at the beginning of our year. And so simply using that rolling 3-year period, I can calculate that my estimate is £1.4 million. That's my transaction price. That's where I'd start accounting for this transaction at the start of my year. However, as we talked about earlier, the SORP requires that we reassess this estimate at the year end. And so the college now, hopefully in the information that it's had an absolute bumper year at the canteen, needs to go back, needs to recalculate that 3-year rolling average, and hey, they might come to £1.5 million. So at that point, we need to essentially reassess our transaction price and increase it by £100,000. Thankfully, that transaction price is allocated to just the one performance obligation in step 4, so we don't need to worry about splitting that average across different performance obligations. And again, the performance obligation is arguably met over time, being each month that Yum Yum Limited provide that catering service. So again, there might be some accrued income that gets chipped away out throughout the year with that year-end adjustment for the change in estimate. Example number 3, and hey, just because the SORP finally started talking about donated services, I thought I'd include an example here. We've got the management team of a university who believes that there's unfulfilled demand for additional student accommodation near its campus. It wants to commission some market research to see whether this belief can be substantiated before submitting to those charged with governance a major capital investment proposal. Thankfully, the pre-approved budget's got £100,000 in there for these kind of innovation projects. And because that's been unused, management think this would be a great use of that money. So they go to the Audit and Risk Committee, they go and tell them their plans, and thankfully, at that meeting, one of the governors says, oh, I've got a friend. They're pretty good on market research. I'll go talk to them. So when they next meet, the friend kindly offers to do the research pro bono. Happy days. It's going to fit into the company's CSR program nicely. And the research is performed. So this is a non-exchange transaction. We know we can only recognise it when resources can be measured reliably. It's a donated service. And so we need to value that at the value to the institution. And that's the price that the institution estimates it would have paid on an open market for that same service. And so in our scenario, we know management have got this unused budget of £100,000. They were willing to go and spend that on the market research. So the value of our donated service is that £100,000. Nice and straightforward, eh?
What happens if the company who did it turned around and said, "Oh, we would have normally sold that for 200,000"?
It doesn't really matter what they would have sold it for because it's what the institution would have paid for it.
Fair point.
Right?
Well, they might have gone to a.
They might have got out the tender, and they might have got a tender of £200,000 from that one, and a different market research company of £100,000 and says we can't justify 200,000. We'll go for that one. The value to the institution. Sticking with donated non-exchange transactions, let's continue with this same scenario. Management was successful with their major capital investment proposal. The research was positive, and it got approved by those charged with governance, and they start tendering for the construction of their new halls of residence. They get a rather trailblazing firm of architects involved who produce the design, and they're insistent that the building be 90% glass. It's a building of the future, right? Now, despite that amount of glass costing 15% of the overall £10 million construction budget, the university agrees with the architect's plans. They're on board. They do a tender exercise, they appoint the local contractor, the project's a year in, and the university is starting to have second thoughts about whether it can afford the now what feels like excessive amount of glass. They hold crisis talks with these architects, who, thinking that this design might be a kind of career-defined, award-winning project, offers to cover 25% of the cost of the glass. The university accepts the offer. So again, it's another non-exchange transaction. The donation of the cost of 25%, I think there's a small typo there in the slides, of the donated resource should be measured at a fair value. And that, again, is the price the institution would have paid on the open market. Now, the crisis talks might bring into question whether or not the university would have paid, but, you know, it was included in the budget. They were going to go ahead and pay that 15% of the total budget. So let's assume that they were going to go ahead with it. So our 25% offer of 15% of that total budget is £375,000. That's the value of our non-exchange transaction. Clearly, there's another typo in this slide because our debit and credit at the bottom should be £375,000. That's the value of the donation. And so that's the value that needs to be incorporated into the cost of our fixed asset. It's not an expense like the previous example. It's now part of the cost. So there we are, 4 examples. And I think that takes us to our Q&A.
Fantastic. So we'll stop sharing. And I don't know, Joanne, do we have any questions?
I think Roger's made a useful comment in the chat. So this was around the time you were talking about between revenue with contracts with customers and government grants, and the difference between recognising some of the FE funding across that, and noting that that would probably be the case, but as long as the reporting isn't aligned with the fiscal years, so there could be a difference between the academic and fiscal years of funding.
Yes. Yeah, that's exactly right. And that's where I think quite a number of FE institutions will be thanking their lucky stars, I suppose, given the fact that they have a determined July year end. Now, that's not to say that that's set in stone. We do know that the Treasury is insisting that colleges change financial year end, and we've yet to hear the outcome of that. I hate to say it, this is just would be an added complication to that should it go ahead. So very much eyes on that space, but as things stand, as we said in the slide, we don't see a huge difference at this point in time in that revenue recognition.
We've got a hand up from Brian Page, which I'll try and allow to.
I think it's following up the same.
Check if he'll be able to answer the question.
Yeah. Same question as Luke.
I don't think people can unmute, Joanne.
Oh, right. So maybe if Brian's able to add his question in the chat, I'll be able to.
Hello, can you hear me?
Oh, we can. Hi, Brian.
Oh, hi. Thank you. Sorry about that. I had to unmute my machine. Yeah, thank you very much. It's very, very helpful. One thing that did just struck me is that when you talk about the scholarships and the reduction in the tuition fee income, correct me if I'm wrong, but normally I thought really institutions until now in that situations would show the total tuition fee as income. But it would appear from your earlier slide that going forward, that won't be the case because it will be reduced by 2,000 to the 7,535. So the thought goes through my head, won't really affect FE colleges. I would imagine more HE institutions. But if that were to be the case, are we really saying then that it's a question of they would then show a reduction in income compared to a previous year? So in other words, let me give a scenario. If you had students paying 9,500, you had 10 students on you had students and income was showing 95,000. If they all got scholarships of 2,000, are we now showing in the next year that wouldn't show as 95,000 but show 75,000? So in other words, would that reduce the total income of the institution in an extreme case, or indeed a department if you're looking at financial contribution calculations?
Thanks, Brian. It's a good question, and one I think that most of us in preparing for this and reading the SORP have kind of gone through itself. Much earlier on in section 16, I think it is, the SORP clarifies that we really need to avoid double counting of income. And I think the point that they're trying to make here is the fact that the institution must be in receipt of the funds to be able to award as scholarships in the first place, and it would have recognised that income at the time. So again, as you say, perhaps less common for FE colleges, but more the case for HE institutions. They might have a restricted fund or an endowment fund that exists solely for the issuance of scholarships and bursaries. Now, when that fund was created or got topped up, we would have recognised income. We would have recognised income from donations and endowments. And so the risk of showing tuition fees gross instead of showing it net of that disbursement of bursaries or scholarships is that we're double counting that.
Oh, okay. All right. Okay. Yeah. I take your point. Yeah.
And so I think that goes back to that disclosure point where wouldn't it be nice if we had to show what the gross was and actually how much bursary or scholarship was awarded in the year, and hey, maybe that could be cross-referenced to the kind funder who gave us the money in the first place to do so, and to kind of show that journey, because otherwise, it looks a little bit confusing.
Yeah. All right. No, thank you, Joe. Thank you, Stuart. I mean, I understand where you're coming from about a double income, but it's just I was purely just thinking if you, say, went down to department level, but they'll have to think of a way of dealing with that. Thanks very much indeed. Thank you.
No, thanks, Brian. Does that tie into Luke's question, Joe?
I believe so. I think so. Hopefully that covers Luke's question. Just checking through, the other person I think may have put their hand up was Hillary. I don't know if Hillary still has a question she'd like to propose.
Questions. Julian.
Yeah. No. Don't think Hillary's
here. Yeah.
Oh, I can unmute.
You can.
Sorry.
Okay.
Someone's obviously in admins. letting us talk. So basically, we probably will have a year end courses that straddle our year end. And so I know you're sort of saying, oh, most people won't have this issue, and therefore the revenue from tuition fees will be recognised in one financial year. We're not going to have that. So just sort of as a basic thought process going forward for the general tuition, if someone's agreed and the contract states they're going to have tuition from month 1 to month 12 and the fiscal year starts, ends in month 7, from a tuition point of view, is an apportionment and a sort of like a 7 months, 5 months seem a reasonable thing, with specific things that they might do, like a trip or something like that, allocated into a specific time frame? Or should we really be looking at how much teaching time they're getting or something like that? Because obviously towards the end of a course they go off, they study for their final exams, and we do the marking and stuff. Is it still fair to sort of apportion that equally over the months, because that's the contract we have when it's expecting to end? Or do you think we're going to have to do some much more calculation on that? I'm hoping it's the former.
I think we all are, Hilary. It's a great question, and again, one that we've been talking about as a team internally quite a lot. And I think it really goes down into the detail of that contract and what the performance obligations are therein. If the contract's as simple as saying, we will provide you with this course over 12 months, until you get your certificate at the end, nice and straightforward, right? But if it's that, and you'll get 10 hours of lab time and you will go on this trip, then you may well need to start thinking of those as separate for performance obligations, allocating that total transaction price between those. And then when you get to your year end, assessing that contract and saying, well, which of those performance obligations, or how much of each of those performance obligations have I met? So that could be quite a lot of work. But I guess it depends how you assess that contract and how judgmental you want to be.
When you contract with a student, you expect them to finish the course to the end and get their degree, and those specific timeframes are set out over however many months that might be. So I would have thought we probably would sort of unify the tuition over the months, and not worry tuition fee over the months, and not worry too much about what they're actually getting at any one point. If we were to do that, is it likely to be the auditors that pick up that maybe that wasn't the best method? I mean, what are the implications if our interpretation isn't, or are we just going to wait for these examples? I mean, that's the thing. We've got a SORP. We have to interpret the SORP and deliver it as how we think, and discuss it and argue it with the auditors, vice versa, to try and get something that's practical, and wouldn't be materially out, I'm sure. But so there would be identifiable specific elements that we might, pin to a particular time frame in one financial year or another. But without doing a completely complicated model. I'm sure that's not what the SORP's about, trying to just completely complicate institutions' accounts. My gut feeling is we would be apportioning on an equal basis over the length of the course, where the contract is you're going to pay your tuition fee, and we obviously would look at things about if they were to leave, at the probability is that they're going to finish it. Then that's probably how I would interpret it, unless we get some guidance to say it's going to be different. Is that a fair way at the moment with the information we currently have? So I appreciate you waiting for.
Yeah, I think it goes with pretty much other things, Hilary. Like, essentially, you will be making estimates and judgments in there, and like everything, your auditor, the watchdog, not a bloodhound, is there to sort of make sure that those estimates and judgments are reasonable and fair, and don't materially mistake the accounts. And one of the things that we will be on the sort of tip of everybody's mind, especially if you're an FE, is, well, does any of this affect my financial health grading? do my stakeholders look at me differently? Do bank covenants depend on any of this? So that, yes, the first piece is about, you know, conversations with the auditors in terms of fair and reasonable and consistency and so forth. But actually you will have one eye on the wider stakeholders. That will be front and center, and there will be potential motivation there to window dress or misstate. So yeah, got to keep an eye on it.
So maybe it's a good thing to just talk to the auditors in advance on what our approach is going to be.
Definitely. Just to build on what Sue was saying, it might be that you want to almost kind of play the scenario out in the possible situations that could be considered, you know, within the range of expectations or interpretations, to almost prove that it doesn't have a material impact on the financial statements. It's kind of, lots of our clients will know that we encourage them to produce a board paper that sets out accounting estimates and then what the alternative estimate could have been, to prove that it doesn't, you know, that the one that has been adopted is materially reasonable.
And Hilary, I also noticed in there you did ask for a copy of the slides. As mentioned at the beginning, they will be on our trustee hub in the next week or so. So you can go over this to your heart's content.
I think a lot of people are going to be going over it. Yeah. Okay. I think that's all the questions I had. Thank you. I couldn't turn my camera on. I'm not trying to be rude or anything. I couldn't work out how to do that. So, and someone obviously put the mic on, so that's fine. That's what we'll do then. And yeah, we're a higher education, not so it's OFS. So I'm assuming OFS and the income that we allocate. Well, that you know, well, that's on fiscal year anyway, so it's not an issue. Well, it could be, because obviously we're so I just have to think about what that might look like there as well. Okay, thank you.
Brilliant. Thanks so much, Hilary. Okie doke. Right, I think that wraps us up. Thank you so much for attending. For those of you who are so keen to get into leases, you've got 2 weeks to wait, but don't worry, we'll be back and really welcome your engagement and questions. If anybody does have any outside of the webinar questions, feel free to get in touch. Obviously, if you're already a client, we can give specifics. If you're not a client, then we can only give you general what our thoughts are, theoretical answers, but happy to do so. There will be a follow-up email just to make sure that you all got what you wanted out of this webinar. So many thanks for attending. And thanks for Joe for doing the heavy lifting there. And we'll see you all soon.
Take care. Bye.